This is consistent, right? Aggressive rate cut policy is consistent with their respective higher $3,000 calls. Now, who are they? Well, Goldman Sachs is implicitly one of them, but there are others. Therefore, these banks, when and if they change their rate projections, will be de facto lowering their gold targets, regardless of what they say about physical demand.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci. Today's market rundown, we will be discussing gold price targets and Fed policy, which will be a bigger factor this year than it has been for the last one. In premium, we'll have an extended discussion on this topic, including a portfolio update, because I just put something on and it would be relevant to the discussion we're having here. Let's start with the markets. 10-year yields are up a basis point or so at 463. The dollar is 108.21, down 6. I'm looking for that to crack 107 before I get bullish on everything. The S&P 500 is 59.87, up 4. The VIX is 16.08, up 5. Gold is 26.51, up 15 and change, very nice. Silver is 30.26, up 33, also very nice. Back to your normal relationship. Gold up 0.5%, silver up 1%, that type of stuff. Copper, again, strong, but not as strong as silver, 415, up 3.5, 3.75 cents. WTI is 74.26, up 65. That's been the winner. Natural gas 366, down 9 cents. Also the winner if you can stomach the volatility. Bitcoin regains 100,000, a little weaker today, 100,000, spot 879, down 1,400. Ethereum is 3637, down 50. Palladium is 932, up 10. Platinum is 948, up 12. Gold, silver is now breaking down. At least that's what we hope. 87.58. Soy, corn, and wheat, 985, down 8. 446, down 2. 546, up 40 basis points. Okay, so there's the story we're going to talk about. It's actually kind of important for, I'd say, the next 3 months. There's the homepage. Silver restarts on China relief. That story yesterday, we started out very extemporaneously, very live, saying, well, something's going on in China. We were wrong about something going on in China, but we were right about something affecting China. And that was a story by WAPO that claimed Trump's universal tariffs won't be so universal after all, and that bolstered everything that China would buy, including China stocks. Again, and we put a note out on that in the post saying, hey, all Trump has to say is that's BS, it's fake news, and it all gets unwound. But he hasn't said anything yet. So what does that tell you? The story we're going to be discussing today is one that I put out on Sunday, January 5th. Goldman's gold price forecast, what to watch. Now, it says Goldman there, but it refers to basically any bullion bank that operates largely in the United States. So we're going to get into that in a second. CFT Sunday gold discussion. We just put that out. Normally we email it. We didn't email it today because of the volume of content, but that's a very long academic, but also community discussion on gold, the CFTC report, which was kind of screwed up, but the analysis actually ended up being accurate. Some interesting questions were asked by the founders that I answered as best as I could, and that's shared with Premium today. There's also a table of contents, so you don't have to, muddle your way through it trying to figure out what you want to watch, but you should watch it. All right, the discussion, gold price targets and Fed policy. All right, we're going to do a little slideshow for you here while we're voicing over the previous post that we're going to show you. So there's slide 1. We start off with a quote from our Sunday note to premium subscribers entitled, gold price targets, and Fed policy. Bank price targets for gold are comprised of two main factors: physical and financial demand. Supply doesn't enter into the equation here. Physical demand is exactly what it is. How much gold do they want for gold's sake? They want the gold. Financial demand is driven by monetary policy, by central banks. And financial demand is driven by correlations. It's driven by neo-Keynesian economics. It's driven by the dollar is money and gold is trinket. Then if dollar goes up, then trinkets get less expensive. That's the whole ideology behind it. Okay, last year, for multiple reasons, and the year before that, but it just wasn't so obvious to everyone. Uh, Reasons like geopolitics, collateral needs, right? Crisis of collateral. That's the Zoltan Pozsar title. Multipolar de-dollarization, something we discussed here many times. Those obliterated most monetary policy factors as manifest in resetting financial correlation. So the correlations broke down. The chart you're looking at there is starting in 2022, when the Ukraine-Russian war started, financial correlations, which were already teetering, broke down. Now, the chart you're looking at there is gold's weekly chart, juxtaposed with, in the red or burgundy, the interest rates for U.S. bonds inverted. So for most of that chart, more or less, gold's price was in part governed by the opportunity cost of interest rates. If interest rates are 5%, I won't buy gold. I'll buy something that yields me 5%. And then after the invasion of Ukraine by Russia and the subsequent sanctions by the U.S. on Russia, the world said, you know what? I'm not so worried about the return on my money. I'm worried more about the return of my money, which literally is like, I forget who said that, but like Hayek, I think maybe. I'm not sure. Mises, but it's and someone uses it as a tag that I really respect out there as well. It's just, it might be Egon Grayer's. It's just so apparent here that when the war started, the world said, well, if they're not going to give Russia back their money, maybe they won't give us back our money. Get out of your treasuries. I don't care about your 5% or 4.9%. I want the money back. And so they started to want the gold. And that's an explanation of that chart. So this has measurably gone on for 2 years, as you can see. Will it continue? The answer is yes, it will continue. But the question really is, will it continue in the way it has, or has the correlation reset? Meaning it'll go back to tracking each other, but at entirely different levels. Another way of looking at that is, if you're an equity person, is the beta has adjusted. The correlation is still intact. Some banks think yes for 2025. Some think no. That's what we're going to explore here. Which banks think yes and which banks think no. 2 weeks ago, Goldman reiterated their $3,000 per ounce price prediction for 2025 forcefully, citing the physical demand. The reasons were, as I just said, physical demand will outweigh Fed policy. Now, keep that in mind as I show you the rest of these charts. This chart is Goldman's rate forecast for every G7 bank, more or less. So Goldman Sachs and two other bullion banks are still relatively aggressive on their rate cut projections. Now, I wrote this 2 days ago compared to their peers. Actually wrote it 3 days ago, published it 2 days ago. This is consistent, right? Aggressive rate cut policy is consistent with their respective higher $3,000 calls. Now, who are they? Well, Goldman Sachs is implicitly one of them, but there are others. Therefore, these banks, when and if they change their rate projections, will be de facto lowering their gold targets, regardless of what they say about physical demand. Meaning, the physical demand will still be there, but the Western impulsive ETF normal investor neo-Keynesian mindset will back off a little bit, presumably along with gold prices and stock prices. So if I wrote this, if you literally hear Goldman, Citibank, or Bank of America change their rate forecast to match their peers, watch gold. Those banks' bigger clients will sell along with their prop desks. The other two will follow. So the other two banks will likely follow suit. A week later, they will lower their gold price targets publicly. Generally, that's how it works. Because when you have a rate change, this is not a negative comment on when you have a rate change, it comes from the top. And then the other divisions trickle down. All the stock market analysts lower their projections, gold, et cetera, et cetera, et cetera. Now, here are the bank price targets through different lenses to add some perspective. So here are the gold price targets for 2025 and some for 2026, keeping that in mind. Right now, you may not be able to see it, but it's not a complete list, but it's a partial list comprised of banks, uh, investment advisors, uh, YouTube celebrities, a couple technicians that we respect, and some people that are uh, just well known in other industries that get screen time for this sort of stuff. All right. Your first chart is what I just said it is. Now, second chart, I'm going to walk through these charts visually here. Second chart, I blurred out everyone who's not a bank. And the little comments in red that you can't see, you're not meant to see them on the screen. You're meant to read them. And plus, they're just notes to me, right? On the left-hand side, blurred out are people who make money selling other things. They sell stocks. They sell Bitcoin. Okay? They have the lower price targets. And on the right-hand side is a combination of bearish economists. They think things are going to go down, but they think we're in for a problem where you're going to have a weaker dollar while stocks drop. Advertising shills, you can figure out who they are. And true believers, people that are technicians, people who see a combination of things and just, they're just more aggressive in their opinion on what's going on. But everyone who's not blurred out is a bank. And we care about the banks because banks have the customers and customers do what the banks say, more or less. Next chart. These are the American banks. The American banks are Morgan Stanley, left to right, JP Morgan, Goldman Sachs, Citigroup, and Bank of America. Morgan Stanley is a bullion. All these are bullion banks, right? Now, there are many bullion banks, but of these five, four are very dominant, very prominent, I should say. Morgan Stanley is a lesser prominent bank in bullion bank dealing these days. Over the years, they have moved their business out of there and focused on other areas. But they still are bullion players. They don't lead with that information. And on the right, you have JP Morgan, which comes in under 3,000, which we know is handling China's business, as well as American COMEX replenishment business. Goldman Sachs, which we are pretty sure, well, they know about China's business. They may or may not be handling it, but they certainly know about it based on their analysis. Citibank is next at 3,000. If they're not handling China's business, well, then they're not doing their job. They're one of the biggest global commercial banks in the world, and they're very low key in their business dealings in bullion, but they're a player, and they're very good. Let's put it that way. And then Bank of America, who has definitely been dealing in the silver market. They also have a big naked short, and so people think it's naked. I don't think it's naked, but that's another conversation. But Bank of America has been vocally bullish on gold for over a year, hinting at it for a year and a half via Hartnett. So if you look at these five banks, the three on the right, Goldman, Citigroup, and Bank of America, are calling for 3,000 gold. JP Morgan just under 3,000, as is their style, and Morgan Stanley out in the weeds lower, but they're not as focused on it as they used to be. The bank that we care about, incidentally, that's not an American bank, is UBS, and UBS is calling for lower this year than the American banks, but higher in 26. And we're kind of fanboys of UBS lately. Okay. Anyway, so there you go. American banks are skewed to the right. American banks are skewed higher. American banks, for the most part, have lower rate targets for the US Fed than other banks. The 3,000 Club is comprised of Goldman Sachs, Saxo Bank, Citigroup, and Bank of America. Now, Saxo Bank is a bank. They're not a bullion bank. They're very heavily commodity skewed, and a lot of their information and news is commodity based. So let's just say that they're a rare European bank that's bullish gold. Think about that, right? If you look at this chart, you actually can see it's kind of ideologically split. Woke to the left, neo-Keynesian woke to the left, and capitalist. And on the right, you've got American, we just want to make money capitalist, and we're only woke because they told us we had to be for a while. All right, so there's your charts. Now, looking at this, the conclusion, I'm trying to give you a premise to work with. The conclusion is, if a bullion bank lowers its rate cut, I'll come back to this chart here. If a bullion bank like Goldman or Bank of America or Citibank lowers its Fed rate cut projections, independent of other players, watch gold and silver. If stocks drop due to a bank dropping its rate cut outlook, gold may not follow suit, but American investors of the ETF variety will not buy gold as much as they did prior to the election. So be advised. Now, this chart here, to put a little bit perspective on it, it's basically the U.S. Goldman Sachs rate cuts. We got this on Friday, and the red areas that we marked off, that's Goldman's. The dotted line is the price trajectory of rate cuts that it's handicapping for 2025, and it's a percentage point lower. Now, that's 3 days ago. Since then, their rate policy has changed. It may have changed before that, and we didn't know about it, but the point is, we put this out on Sunday, wrote it on Saturday, put it out on Sunday, and boom, yesterday, we got some new information. So be careful, is I guess what we're saying. And that will continue, this discussion will continue in premium, where actually we'll disclose a trade that I put on to that effect. And you can probably guess what that trade is. News and analysis, CFTC Sunday discussion on gold, silver restarts in China relief, Rickards, Jim Rickards, Trump's plan to end currency war 3.0. These pieces are very good because this is an insider, and you can say whatever you want to say about him in terms of price predictions. You have to learn how to separate price predictions from actual wisdom and knowledge. And he knows these markets, and he understands how an insider, how policy wonks will think in order to do that. The price projections are just fluff, okay? But this is the type of stuff that you want to read, This is kind of like, remember the first books that he wrote? Well, those were great books. They're all great books, but the point is, this is like those books. You want to read this if you can. I truly recommend it, and that is Unlocked. The next post there, 2024 American Odyssey. That's a story that basically it's actually, these top 10 lists for 2024. Well, this has 44 things in it that you can read in bullet form very quickly. And each, like on 25 of them, I went, holy shit, I can't believe that. And it's basically statistics and data that show you how crazy 2024 is. And we actually saw that first on Zero Hedge and are reposting it. It's really good. It's also Unlocked. 2025 3,000 price forecast. That refers to what we just talked about. And the Founders Sunday permanent link. Bookmark that if you're a founder so you can attend the classes. Moving on. Market news. China's regulators sought to reassure markets on Monday as equities and the renminbi extended losses and a rocky start to the year following weak economic data and geopolitical uncertainty ahead of Donald Trump's inauguration. That's the FT. And we told you that the market already reacted to that down a couple days before and on its way up. There's other stories there. U.S. Steel, Nippon, et cetera, et cetera. Data on deck. Unemployment rate this week. Today, you have a lot of speakers. I think there's like three of them, I'm not sure. And the ISM, which the ISM is important, as important as the PMI. It's basically the same family of data. Tomorrow is the Fed, the minutes of the Fed's December meeting. All right, let's take a look at the chart. So there's silver, another fine day for silver. Well, it's looking good. What do you want me to say? I can't really say much more. It's above this line. I think it's going to that line. There you go. That's it. On the moving average basis, it's above the 200-day, and I think it's going to the 100-day. And there you go. That's it, right? Gold. Gold is above the 100-day. So the 200-day for silver is the 100-day for gold. And there are all kinds of other things you can look at here. So I'll give you an example. One of the things I've been saying for the last month for the holiday season was don't get excited about gold until the RSI starts to move. Now the RSI is starting to move. It's well off its lows. You look at this, gold made a new low in the market, here. No, I'm wrong. It didn't make a new low. Well, you have a rising RSI with a rising market, so you can rationalize that as a reason to be bullish. I did not. I just think that the whole thing is in a sideways range. But we are kind of moving. Here, I'll show you the silver RSI. Silver RSI is much better. All right, so silver makes a low, RSI makes a low. Silver makes another low. I believe it was a new low. RSI does not. And that tells you momentum is running out of steam on the downside. Now, you wouldn't get bullish until we got above a certain level, which we did. And so now I'm bullish, right? Despite the rate thing, all this other stuff. And we're going to talk about that in a second. Which brings me to, since we're talking about stuff that I care about today, we're going to talk about this in more detail, but this is the gold-silver ratio. And I want to stretch this. I want to just make this a little bit clearer for you here. Those of you who follow Michael Oliver's work, he was, I don't know if he still is, was a big fan of this channel. And we had drawn this channel ourselves independently of him. And we drew it as part of, sorry about the cursor on your screen there. We identified this channel years ago, cost us money. And then we said, okay, here's that channel again being reformed here. And the market certainly honored it for a while with one breakout above and then one breakout below. And then it went back in and I said, oh crap, it's over. This channel's dead. And we were measuring it all the way back here, 1767 in silver or the year. And it got into it. We said, okay, we don't care anymore. But now it's below it again, which forced us to say, well, maybe the channel doesn't matter anymore, the rising channel. Maybe the sideways channel does. Anyway, independent of all this stuff, of all these charts, we're long silver and we're short gold against it. And so that's the trade. That's it. Have a great day. Catch you guys later.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.